Good morning, everyone. We have completed some excellent preliminary findings. Let's start with the key areas where we have identified potential risk, the sudden increase in account receivable, and possible errors in inventory records. Pirevin, let's start with you on the receivables. What's the very first step we need to take when we see a significant sudden jump in that balance?
Good morning, Irene. The first step we need to take to address that sudden increase is to check the company's credit policies and payment terms. It helps us to understand the fundamental structure of us the company manage the credit and collect money from customers. For instance, if they recently changed their terms from net 30 days to 60 days, to boost the sales, it explains that the increase but not raises the risk uncollectible amounts. Once we understand the policies, we can analyze the aging report to see how invoice has been outstanding, which helps us to spot overdue payment and unpotential bad debts.
Excellent. Understanding the way is always critical before diving into the numbers. Sarvesh, moving to inventory. The physical count is a cornerstone of of our work. How exactly do we use it to detect errors?
For inventory, we use a three-part approach. The most direct is performing physical inventory count and comparing with the result with the system record. The whole point is to physically count the stock and compare it to the recording amount in the accounting system. If the system says 500 units but we only have 450, that immediately flag potential the misstatement or the recording errors. It a key check on the assisted assertion.
And to back up the physical count, we also need to look at the overall picture, right? We need to use analytical procedures. This means analyzing financial ratios like inventory, turnover, and gross profit margin. If we see significant deviations from industry norms or the company's past performance, say a sudden drop in turnover, it might signal obsolete stock or material misstatement in the inventory value.
Well, guys, I think we should also need to perform cut-off testing. We check inventory transactions, especially from sales document near the reporting date, to ensure that the recorded in the current accounting period. If good received on the 3rd December, it was recorded in the correct accounting period. So we must ensure that the inventory was not recorded in the wrong accounting period. So if the prior year inventory balance would be overstated.
Great summary, team. The combination of physical verification, analytical review, and cutoff testings gives us a robust picture. Now let's quickly discuss two high-risk scenarios. Harisha, what are the implications for the financial statements if we find expenses that lack proper supporting documents?
Finding expenses without supporting documents has three serious implications. First, it results in a lack of audit evidence. We can't confirm the occurrence and accuracy of the recorded expense. Second, it increases the risk of material misstatement, especially an overstated of expenses and an understatement of profit, because we can't confirm the transactions are legitimate business transactions. And third, it indicates a serious weakness in internal control deficiency.
Precisely, the lack of documentation fundamentally impairs our ability to confirm the numbers. Finally, surveys, let's discuss the most serious finding. What actions must we take if the final actual elements of fraud in the financial statements?
If we find elements of fraud, we need to take four immediately action. First one is communicate with the appropriate level of management and those charged with government TCWG. Second one is evaluate the implementation of the fraud on the financial statement and our audit procedures. Third one is perform additional audit procedures to determine the full assessment of the fraud. Finally, consider the impact on the audit opinion, as the fraud may be material enough to warrant modified opinion, like a qualified and advised opinion.
That's exactly right. Our professional and ethical duties are clear in that scenario. Excellent work, team. You have very clearly grasped the exotic critical procedures for these key audit areas. Let's move on to drafting our working papers based on the finding. Okay. Now we will discuss the question 2 from our mini project about subsequent events from for IMAR company SDNBSD. I want each of you to share your understanding of three events that happened 31st December 2023, and together we will decide whether they are adjusting or non-adjusting subsequent events. Ready or you all?
Yes, ready, Irene.
Sarvesh?
Yes, ready, Irene. I will start with the first event, the warehouse fire on 10th January 2024. From what I understand, the fire happens after the year end, and it doesn't related to a condition that exists on 31st December 2023. So it could be not adjusting subsequently event.
That's correct, Sarvesh. Can you explain why it doesn't consider non-adjusting?
Sure, because the fire is the new event in the occur after the reporting period. It doesn't affect the financial position as of 31st December 2023. The company should just disclose it in the notes to the financial statement if the amount is material.
Excellent, well explained. Now let's move to the second event.
I will take that one. The second event happened on 25th January 2024 when the company received a lawsuit of 2 million due to defective products sold in December 2023. Since the defective products were sold before year end, this event gives further evidence of a condition that already exists as of 31st December 2023. Therefore, it's an adjusting subsequent event.
Good point, Harisha. What should the company do in this case?
The company must adjust the financial statement by reorganizing a provision for the lawsuit because there's a probable outflow of resources.
Perfect, Harisha. That's exactly in the line with IAS 10 requirements. Nicely done.
Next, I will explain the third event, guys. On 5th February 2024, a large customer owing over 1 million was declared bankrupt. Since the customer went bankrupt so soon after year end, this likely confirms that the receivable was already impaired at the 31st December 2023. So this is also an adjusting subsequent event.
That's right, Piravin. And what action should management take for this event?
Okay, they need to adjust the financial statements by increasing the allowance for doubtful debts or by writing off the receivable to reflect that is not a recoverable.
Okay, exactly. That's a clear explanation. Excellent job, everyone. This discussion shows that you understand how to differentiate between adjusting and non-adjusting events and how each affects the financial statements. Now, we will discuss the question 3 about the modified audit opinions under ISA 700. Can anyone tell me these two situations where an auditor should modify their opinion?
Here, one situation is when there is a material misstatement in the financial statement.
Sarvesh, how about you?
Where the auditor can obtain sustained and appropriate audit evidence, which is known as a scope limitation.
Oh, exactly, Sarvesh. There are two main reasons we issue a modified opinion. Now, let's go through each type of opinion, starting with the qualified one.
Okay, let me explain about the qualified audit opinion, guys. A qualified audit opinion is issued when there is a material misstatement or a limitation in a scope, but it was not pervasive, meaning it is only affect a special and a specific part of a financial statements. For example, if a company faces a going concern issue, but it doesn't disclose it properly in its notes, it creates an uncertainty about the company's ability to continue operating. However, because of the misstatement, only affect one area at the entire set of financial statement. The auditor issued as a qualified opinion, guys. So this type of opinion tells users that expect a identified issue. The rest of the financial statement are true and fair view. It's basically saying everything is fine except for this one part.
So, what about a disclaimer of opinion, Irene?
Good question, Harsha. A disclaimer opinion happens when we cannot obtain enough evidence to form a conclusion. For example, if management refuses to give access to important records or documents, such as confirmation for a material account receivable, that's a scope limitation. When the issue is the both material and perspective, meaning it affects the large portion of the financial statement, we issue a disclaimer. This means we are unable to express an opinion because there is not enough reliable evidence to conclude whether the financial statements are true and fair view.
At the last, adverse opinion, right?
Yes, exactly. An adverse opinion is issued when the financial statements are materially and perceptively misstated. For instance, if management fails to disclose a major related party transaction that's required by the financial reporting framework, it seriously misleads users. In this case, the misstatement is material and persuasive, meaning it affects the entire picture. Therefore, we issue an adverse opinion because the financial statements as a whole do not present a true and fair view.
Okay, guys, let me summarize our discussion now. Okay, the first one is a qualified opinion. It is issued when the misstatement is material but not pervasive. For example, inadequate going concern disclosure. Disclaimer of opinion is issued when there is a scope limitation and we cannot obtain sufficient audit evidence. And for example, client refusal to provide records. And the third one is adverse opinion, issued when the misstatement is both material and pervasive. For example, undisclosed related party transaction. Each type of opinion communicates a different level of seriousness to the users of the financial statement, helping them to understand and reliability of the audit report opinion.
Perfect explanation, Piravin. Very clear and complete. That's exactly how we distinguish between the three types of modified opinions.
Thanks, Irene and Piravin. This makes the concept much easier to understand.
You are welcome, team. Always remember our opinion carries weight, so it must be supported by the strong professional judgment and sufficient audit evidence. Thank you, everyone.
Thank you and the team.
Thank you everyone.